Okay, let's just get right into it. If you look at a dense, math-heavy formula like, well, P0 equals D0 times 1 plus G over RE minus G, does it kind of make your head spin? Because honestly, it's enough to make anyone just shut the book and walk completely away. But hey, don't panic. We are officially putting away the calculator today. Instead, we're going to focus on a highly visual, structured playbook of how corporate finance actually works in the real world. So no massive equations to memorize here, just pure, straightforward logic. Welcome to this explainer on demystifying corporate finance. I am absolutely thrilled to guide you through this because we're taking a really unique zoom-out approach. We're going to untangle the invisible mechanics of the economy, starting from the tiniest piece and progressively zooming all the way out to the big picture. So here's our roadmap. We're looking at the financial manager's role, the power of intermediaries, capital versus money markets, bulls, bears, and brokers, and finally, are markets really efficient? First up, the financial manager's role inside the company. Let's start at our most zoomed-in point, right inside a single business. Meet the financial manager. Their absolute main job is making the right decisions for the company's future, and they really have three core duties. First up, raising long-term finance, basically figuring out where to get the cash, right? Whether that's issuing equity to shareholders or taking on debt. Second is the investment decision. Once they actually have the money, where do they deploy that capital to get gross? Are they launching a new product? Buying up a competitor? And third, the management of working capital, which is all about keeping those day-to-day operations running smoothly. Now, managing working capital, which is simply your current assets minus your current liabilities, is actually a super delicate balancing act. You have to keep your cash, inventory, and receivables high enough so the company operates efficiently, but you also have to keep them low enough so you aren't just leaving money sitting around doing absolutely nothing, wasting its potential. Moving on to part 2, the power of intermediaries, or the matchmakers. Remember that manager's job of raising finance? Well, they don't exactly go door to door asking people for cash, right? They use matchmakers. Think of a bank as the ultimate intermediary. They basically perform 3 bits of magic. First, aggregation. They consolidate our small individual deposits. Second, maturity transformation. They magically take our short-term deposits and turn them into massive long-term corporate loans, betting that not everyone is going to withdraw their money at exactly the same time. And third, diversification of risk. They lend to tons of different companies, so if one goes under, the whole system doesn't just collapse. It's really a brilliant matching mechanism between everyday savers and big corporate borrowers. But, clearing banks aren't the only ones playing matchmaker here. Pension funds, investment trusts, state savings banks, they also play this incredibly vital role. They're all working behind the scenes, connecting regular people's savings with the massive capital needs of growing corporations. Next up, capital versus money markets, the arenas. So where do all these intermediaries and financial managers actually go to interact? They hit the financial markets, which are essentially these massive, bustling arenas. The absolutely crucial point here is the stark contrast between the two main ones. Capital markets are for the long haul. We're talking funding over 5 years, trading things like equities and bonds. On the flip side, you've got the money markets. And what's wild is that the money market isn't even a physical place. It's mostly conducted just over the telephone between financial institutions, and it's strictly for short-term borrowing of less than a year. Let's take a really quick tour of those long-term capital markets. You've got the major players like the official list at the London Stock Exchange. Then there's the alternative investment market, or AIM, which actually has fewer regulations, making it an awesome springboard for smaller companies. And for those massive international debts, well, there's the Eurobond market, which handles 10 to 15-year bonds across a bunch of different currencies.
All right, Section 4, Bulls, Bears, and Brokers, the market mechanics. Zooming out even further, let's look at the characters who actually trade in these arenas and how their actions dictate a company's share value through just raw market forces. We can practically personify the stock market by pitting 2 types of speculators against each other. The optimistic bulls believe prices are going to rise, so they buy shares hoping to sell for a profit later. The pessimistic bears, on the other hand, believe prices will fall, so they sell now, planning to buy back cheaper later on. Their competing beliefs constantly drive share prices up and down until they find a balance where there are exactly as many willing buyers as there are sellers. Now, it's pretty easy to dismiss these speculators as just gamblers, but as our source points out, they actually serve a really vital function. By jumping in to buy when prices drop, they arrest market falls and reduce overall fluctuations. More importantly,
They ensure there is always a ready market, meaning there's almost always someone willing to buy or sell right when you need them to. So, how do those trades actually wrap up? It happens through something called the rolling settlement system. Let's quickly define this piece of jargon. Since most trading is done over the telephone, once a market maker strikes a bargain, that specific transaction falls due for settlement in 10 days' time. It's basically the actual timeline of how those frantic phone calls finally turn into finalized ownership. Which naturally brings us to a bit of a pause. Looking at all these bulls and bears battling it out every single day, you really have to ask the ultimate question. Can anyone actually predict the stock market?
And that brings us to our final framework. Are markets really efficient? The illusion of prediction.
To answer that, we have to explore the macro theory of market efficiency. First up is weak form efficiency. This theory argues that share prices already reflect all the information contained in past price records. They essentially follow a random walk based entirely on what news drops next. So, if the market truly operates with weak form efficiency, those folks you see drawing complicated trend lines on past stock charts to predict the future, yeah, they are completely wasting their time. Stepping it up a notch, we have semi-strong form efficiency. This argues that share prices instantly reflect all publicly available information. If this level of efficiency exists, you simply cannot beat the market based on reading the news. The only way you could accurately forecast a price movement is if you had secret, unpublished information, which of course is illegal insider dealing. So here's why this absolutely matters. Market efficiency heavily dictates how companies actually behave. Because if markets are inefficient, meaning prices do not perfectly reflect reality, companies can absolutely take advantage of those gaps. They can manipulate the timing of issuing new shares to catch a good price. They might struggle with accurate project evaluation, or they might even use creative accounting to mislead investors simply because the market isn't perfectly pricing in their true value. I want to leave you with a really provocative thought straight from our source text. If the market is fully efficient and every single share price is perfectly fair, why do acquirers pay massive premiums to take over other companies? Are the economies of scale really that significant to justify paying way over the market price? Or are they just hoping the market got it wrong? It's definitely something to ponder the next time you see a multi-billion-dollar corporate takeover in the news. Thanks for joining me on this explainer, and remember to always keep zooming out.